Accounting equation and Excel. Record transaction for making loan payments, breaking out interest and principal portion of the loan payments. Get ready and some coffee because we're learning the accounting foundation, the accounting equation using Excel. Here we are in Excel. If you don't have access to this workbook, that's okay because we basically built this from a blank worksheet but started in a prior presentation. So if you want to build this entire worksheet from a blank sheet, you may want to begin back there or just construct your own worksheet as we go, or possibly just follow along with good old paper and pencil. If you do have access to this workbook though, 4 tabs down below: example, month 1, practice, and month 2, the example tab in essence being the answer key, month 1 being the prior month of operations as we're working on the second month of operations, the practice tab having pre-formatted cells so you could practice the practice problem with less Excel formatting. The month 2 tab is what used to be the blank tab, where we started from a blank worksheet but are basically working from a template at this time. However, we will be adding to that template as needed as we go. Let's go to the example tab to get an idea of what we will be doing. We're now looking at the loan payments. So last time what we did is we created an amortization table that is supporting, let me go up top here, it's supporting this number for our loan payable. So we have $72,000 loan payable. We're going to imagine that we have to make payments on that as an installment loan, similar to the structure of a loan you might see for, say, a mortgage, where we pay it off same dollar amount each month, but the breakout between interest and principal will differ. We went over a couple ideas in the prior presentation that I want to reiterate here whenever we're dealing with a loan, that being that we have the option of breaking out the short-term and long-term portion of the loan, because many loans will extend beyond a year, but some of the payments are due within a year. Therefore, for proper reporting purposes between the current and long-term portion, we should have 2 accounts for each loan. However, that is not practical for bookkeeping purposes. Therefore, I suggest having 1 account per loan, putting it either in the short-term or long-term category. I tend to put it in the short-term or current liabilities category, and then we'll break out the long-term portion if necessary at the end of the period, month or year, at least possibly the year, if you need to do so for income tax preparation, for example, or external reporting, which you might not need to, given the fact that if you're sole proprietorship, for example, you might just have to report, in essence, the income statement, which means you've got to get the expenses basically correct. You might not have the balance sheet. So that's one thing to keep in mind. The other thing is that you might have multiple loan accounts. Some businesses may only need like 1 loan from the bank because they're looking to get cash in order to purchase things like property, plant, and equipment. But many companies might be using the equipment they purchase, for example, in construction companies, in order to have the collateral for different loans, which results in multiple different loans that have multiple different pieces of equipment as collateral for it. And if that is the case, I would recommend not breaking out between short-term and long-term for each loan, and having a separate account in our books for each of the loans, so that every time we make a payment, we can tie the balance out to the loan balance for a particular loan, as opposed to having all of the loans in 1 account supported by basically subsidiary ledgers, which are in essence the amortization tables. And then, once again, we could combine those accounts together in the adjusting process to make the financial statements or tax returns basically at the end of the year. That's going to be the easiest way to track the loans to see if they're being recorded properly, breaking out the interest and principal. Lastly, the thing we want to remember is on the bookkeeping side, more and more these days, our goal is to streamline the bookkeeping process, automate it to the extent that we can with the help and use of the bank feeds. And we can't really do that with the loans, as we'll see with the amortization table, because there's 3 accounts affected instead of 2, which we should be able to work around in some cases. But also, there's a difference between the breakout of interest and principal each payment. So we can't standardize the payments. even though they're coming out of our bank account and we know what came out of the bank account, and that number is the same each month. So you could work around this by saying, on the bookkeeping side, I'm just going to record the loan payments, reducing the loan amount. And I'm going to ignore interest, which is wrong, but it's faster to do that way, and then do basically an adjusting entry either yourself or by the tax preparer at the end of the year, breaking out the proper amount of expense on a yearly basis, which can achieve the goal possibly of automating as much as possible on the bookkeeping side while still being able to periodically break out the proper interest and principal, tying into the loan balance for proper external reporting and tax preparation. All right. Those are the methods that we want to keep in mind. Now, we have the amortization table that we created way over here. Let's see, it's right here. So we're going to imagine that we're going to make the two first payments, which I'm going to put at the beginning of the month and the end of the month. So they're still in the same month, but I want to show the distinction, the problem here of having the same payment amount, which will clear the bank and can be therefore automated with the use of bank feeds, but different breakouts of the interest and principal for the first and second payments. So we will record them in accordance with the amortization table, but you could also imagine the other option of just recording this to the loan balance. We'll talk about that possibly as we go, and then adjusting the ending balance according to this amortization table. So if we look at the actual transaction, it's going to have a payment portion. It's going to have a reduction of the cash. It's going to have an interest portion, interest expense, and it's going to have a loan reduction part of it. All right. So let's go over to the months. This is a common kind of problem for many businesses because it's a little bit tricky to record the loan payments, a little bit more complex than like recording normal expenses. Although once we get the process down, it might be a standard payment that we make each time. We just need to know what the process is. All right, so we're going to make believe that the first payment, pay loan payable according to amortization table, we'll say. And we're going to have a payment amount, payment, and then interest. So I'm going to indent these, home tab. I'm going to go alignment indent, and let's go to our table all the way to the right that we have created. So the table's all the way on the right. Now remember that this table was created last time, and it's useful to create the amortization table to get a feel of what we're talking about here. So I really think it's a useful activity to build it in Excel, although I know that's kind of tedious. Sometimes the bank will give you the amortization table, but many times they don't because you have enough information to construct it yourself. They basically are looking to get the payment amount to be within your budget, right? So that they make sure that you pay them, and then they would like to make the interest as high as possible that they could have you pay them the interest, because that's basically the rent on the money. So we built this last time, $72,000 loan, 5 years, which is 60 month, 5% per year, gave us the loan payment of $1,359. So this $1,359, let's make this one green right now, is what's going to come out of our, let's make it light green. That's too dark. That's too dark, man. Lighten it up, please. All right. So that's the amount that's going to come out of our bank account. We'll see that come through the bank feeds, right? If we saw the bank feeds come out. Now, we could record that whole amount decreasing the $72,000 loan balance, but that would be off or incorrect by $300. However, that would be the easy thing to do. And then at the end of the year, if it was like 12 months later or whatever, I'm on month 2, so it would be like 11 months later, whatever the end of the year is, I would tie into the end of the year balance over that's still in the loan balance, and then adjust the proper interest for the year. So that would be the simple way to do it, but usually you have to coordinate with your accounting firm or tax preparer to do that properly. So they have to do a little bit more work. You have to have an actual, like someone that knows accounting that does your your books, or you could do it at the end of the year, and still that might be faster to do so that you can then automate the year and then do an adjusting entry at the end of the year. Okay, but we're going to record it one at a time, and therefore we're going to have to manually do something to the data input for the bank feeds because we have to adjust the interest and principal components and have 3 accounts impacted instead of 2. Of this $1,359, $300 is interest. So interest, I think it's useful to think of as rent because you're basically consuming something. If you rented a building, then you're going to have to pay for the use of the building. That makes sense intuitively to us because it's a physical thing. But here we rented the purchasing power of the money in order to get the money to go and buy property, plant, and equipment in order to make more money. That purchasing power of the money is like renting the purchasing power. So we have to pay back the money just like we would have to give back the building that we rented. And we have to pay interest for the use of the money just like we would have to pay rent for the use of the building. So that's what the $300, we're not going to get that back. The loan reduction is the amount that we have to pay back. So therefore, if we paid $1,359, and this is rounded, minus $300, that means the loan is going to be reduced by the $1,059. So of the $72,000 that we borrowed, we're going to pay back $1,359, but only $1,059 is going to reduce the loan, bringing the loan balance down to $70,941, and the interest is just like rent. It goes away. That's the cost of us getting the loan. All right. So that's the amount. So after we do this, cash should go down by 1,359 about. Interest expense should affect the equity of 300, and the loan reduction decreases the liability of 1,059, bringing the balance in the loan account to 70,941, which is our check figure to make sure that we recorded this properly. All right, that said, let's go all the way back. I'm doing a lot of scrolling. Pardon me. Lo siento por lo scrolling. I don't know how to say scroll. Is there a Spanish word for scroll? I don't know. I'm going to say this is going to be equal to the payment. I'm going to go all the way to my amortization table. I'm just going to move on over there to the amortization table and say this is going to be $1,359. And then we'll pick up the interest portion. So of that, the interest is going to be from our amortization table. I'll pull this in so that we have the building blocks of our transaction. And so that's going to be the 300. And the difference from that is the reduction in principal, which I don't need to put here. That's all I need really to make the transaction. So I'm going to put it down here on this line. I'm going to say that this is going to be equal to negative cash 1,359. And then the expense is going to go up, which brings down net income, which brings down equity. So I'm going to put it in here as a negative of interest expense, which we don't have yet. So where exactly do I want to put it? I'm looking at my worksheet here. I want to put it at the end. All right, let's put it at the end. So I'm going to select the skinny, which is kind of hard to select because it's skinny. But then I'm going to right click on it and insert. And then this is going to be interest expense. Now, because I was all on the end, it didn't really format the exact formatting that I wanted over here. So I'm going to select this entire column and copy the formatting. So I'll select it all the way down to here, Home tab, Clipboard, Format, Paint. And then we'll put that, I'll go all the way back up. I could just use the right arrow, but I'm just going to do it this way so we could see it. So there we go. It's formatted properly. All right. So now we're on, I forgot what line I'm on now. What line was I on? I can't, that's why the zeros are important. Let's go down to here. That's the line 10. All right. So now we're going to say in AN10 negative of the 300. And then the difference is going to reduce the loan payable. I'm going to say negative and then put it in brackets because I'm going to do a subtraction problem and I want to flip the sign to make it a negative. So it's going to be negative of brackets this minus this. So let me show you what that looks like. over here in the formula. It's going to be this minus this, which gives us the reduction of 1,059. And I flipped the sign. That's why I put it in brackets and put a negative in front of it to make it reduce the loan payable. All right, that should keep us in balance if I did that properly. Let's copy everything down and see if it indeed does. Copy this down. Copy this down. I could do this at the same time. Let's just copy both of these. I don't know why I do it one at a time like that. That's stupid. Something is wrong. Something is horrible. Oh, that's because here it's not including the new thing. So if I double click on it, it's not including here. So I have to pull this over because I added a new column to the end. That's why I don't really like adding it to the end a lot of times. But so now that should put us back in balance. So assets went down by the amount we paid out of the checking account, 1,359. Liabilities went down by the 1,059, the amount decreasing the loan amount. And then, of course, the equity went down ultimately because the expense went up, which brought net income down, and so on. Let's put some zeros across the board and let's do some formatting for formatting's sake. For formatting's sake. All right. Another trick that I'm getting better at is I can just put an underline across the whole thing instead of doing it like piece by piece, and I just underline the whole thing, and then I just copy this one down so I don't have the underline under the signs. Boom. That's a little faster, I think. Okay, and then now wait a sec. This isn't. Hold on a second. Something got messed up over here. I put a 0 in the loan. Okay, let me redo the loan payable. I deleted the loan payable. Negative brackets. Watch, just be careful, man. Stop going. I know, loan payable is going to go down. All right, that puts us back in balance. Let's bring down the balance now. So the balance is going to be then equal to the sum of the prior balance. That's going to be this one, not the one up top. I'm just going to pick the second one, on down, enter, and then I'm going to copy that. And then once again, I think I can go all the way across and then just paste it with the formulas only, which is a little faster. And then I'll just adjust these signed ones. Just copy this one down and copy this one down. Boom, boom. So I could see everything. So look at that. So that's faster. Más rápido. Okay, so then we've got, so now where I'm at, 70,941 on the loan payable. That should tie out to my amortization table. Let's see if it does. 70,941. I'm just going to memorize that. I could use the split panes. 70,941. Muy B to the N. All right, let's do the next one. Make this one yellow. I'm going to pretend now that another month has gone by, and we'll do the next one just to show the difference. So I'm going to put it in the same month, but at the end of the month, just so we can see the two payments side by side. I know I'm out of order date-wise, but I want to do it this way so we can see the issue with the loan payments. It's going to kind of mess us up date-wise. So that's the sacrifice I'm willing to take. So let's copy this one down. Some people may die, but that's from Shrek. That's from Shrek. I'm going to then underline this. That's the sacrifice I'm willing to take. God. It's Lord Farquaad says that. In case you, just for reference purposes. Classic, man. But anyways, we're going to say, we'll copy this one down and indent, home tab, alignment, indent. So now I'm going to pull this information from the payment from the loan schedule again. So let's pull this in from the loan schedule. I'm just going to go all the way to the right. Scrolling, scrolling, scrolling. Keep those doggies scrolling. Scrolling, scrolling, scrolling. Let's do the same with the inches. Rawhide. Rawhide. Rolling, rolling, rolling. Keep those doggies rolling. Rolling, rolling, rolling. Rawhide! All right. So now we can see the payment is the same, but the interest portion is different, which means the loan reduction is going to be different. That's the point. Now notice I'm pretending a month has passed. So the end of the month, another payment clears the bank account, but it's for the same amount. So it looks the same, but I can't automate it because look at it. If I go to the interest over here, the interest is different. So I can't just like memorize the last transaction, which is lame because I want to automate the thing, dude. So, but no. Okay. Enough with the sass. We're going to then say this is going to be negative of the difference between the two. This minus this. And so what did we do there? We put a negative and then subtract. So we subtracted them and then flipped the sign. That's why I put brackets and a negative around it. So that should keep us in balance. Let's bring it down and see if it does. I could just select all of these instead of one at a time. Like you've been doing it stupidly. You've been doing it stupidly this whole time. Okay. There's no need to be rude about it. Let's tab through. Let's put some zeros across this thing. And then we'll underline it. So again, I'll just underline the whole thing. I'll just take the whole thing and just boom, underline. But then I'll pull this one down so it underlines these two. Okay, sweet. So then we'll bring down the balance. Bring it down the balance. Bring it down. Bring it down. This is going to be equal to the sum of the prior balance plus the current activity, like always. We'll copy that. And again, I'll just paste it all the way across and then fix the little sign ones. We'll just paste it formulas only so it doesn't mess up the worksheet. And then I'll just go to the little sign ones and say it shouldn't copy this one down, so it doesn't do it there. And it doesn't do it there. You gotta make sure to do that. Okay, so there we go. And then now the loan balance is at 69,878, which should tie out to the amortization table. Let's see if it does. I'm just gonna memorize that number, 69,878, 69,878, 69,878, 69,877, 69,878, MUI B to the N. So you see the problem here is that I can't really automate that. Now again, your solution to that, if you're able to communicate properly, would be I'm just going to automate the payments, and instead of breaking out the interest, I'll just put it all to principal, which will throw me off of the loan balance for the year, and then just adjust it at the end of the year with an adjusting entry, adjusting the loan balance to the amortization table and properly recording the proper amount of interest so that I can do external reporting and my taxes if you're in the United States, so that I have the expense of the income expenses properly broken out. So that's an idea, right? And so that's always something like these days, as things are being automated, that's usually kind of the mindset you want to have in mind. The adjusting entries that we had in the past are still there. There's still an issue, for normal accrual versus cash-based timing differences. But more and more these days, you might use the same concept of adjusting entries in order to maximize the efficiency of data input through automation with the use of things like bank feeds, and then make adjustments necessary to do that. The purpose being similar but a little bit different. Might not be simply a timing difference, but it might be that you're doing something that is faster because of the automation, and then you just shore it up or fix it at the end of the year so that you make things as efficient as possible. All right, let's copy these things down, get our balances down here. We'll put an underline under these, underline under those, and we're in balance. And so that looks good.